3 days ago, a single document landed on the desks of institutional traders across Wall Street. Not a press release, not a public statement, a leaked internal report from JPMorgan Chase. And what it contained sent shockwaves through the inner circles of global finance. The report, marked confidential and dated for internal distribution only, revealed something the bank never intended for public eyes: a catastrophic miscalculation in their silver short positions. And according to their own risk models, they have less than 1 week to cover. The exposure? Over $14 billion. The timeline? Already running out. And the silver market? About to detonate. This isn't speculation. This isn't hype. This is data extracted directly from one of the world's most powerful financial institutions, admitting they are cornered. And if you understand what happens when a major bank gets caught on the wrong side of a commodity trade, you know this story doesn't end quietly. It ends with price explosions, margin calls, and a cascade that could rewrite the precious metals market overnight. So buckle in. Because what you're about to hear isn't just another market update. It's the anatomy of a financial reckoning that's been building for years. And it's about to break. Let's rewind for a second. Silver, the forgotten metal, the little brother to gold, trading at around $28 per ounce for most of the past year. Boring, right? Wrong. Because while everyone was watching crypto crash and stocks wobble, something else was happening beneath the surface. Industrial demand for silver has been climbing at unprecedented rates. Electric vehicles, solar panels, semiconductors, 5G infrastructure. Every single one of these technologies requires silver. Not wants it, requires it. And the numbers don't lie. Global silver demand hit 1.2 billion ounces last year. Supply? 970 million ounces. You do the math, that's a deficit of over 200 million ounces, and it's widening. But here's where it gets interesting. JPMorgan has been one of the largest short sellers of silver futures for nearly a decade, betting against the metal, suppressing rallies, profiting from every dip. It worked beautifully when supply was stable and demand was predictable. But the world changed. Green energy mandates exploded. China's manufacturing consumption doubled. And suddenly, the short position that was once a cash machine became a ticking bomb. And now, according to this leaked report, the bomb is seconds away from detonation. The document itself is clinical, sterile, the kind of language banks use when they're trying not to panic, but read between the lines and the message is clear. JPMorgan's risk management team ran a stress test on their silver derivatives portfolio. They modeled what would happen if silver broke above $32 per ounce. The result? A liquidity event. Translation, they would be forced to buy back billions of dollars worth of contracts in a market that does not have enough physical silver to deliver. And when that happens, prices don't rise, they explode. And here's the kicker. Silver just crossed $31 yesterday. It's already within striking distance of that trigger point. The fuse is lit, the clock is ticking, and the bank that spent years controlling the market is now at its mercy. So how did we get here? Let's go back. Not months, years, all the way to 2011. Silver hit $48 per ounce that year. Retail investors were rushing in, industrial users were panicking, and the banks, they mobilized. Massive coordinated short selling crushed the rally. Silver plunged back to the low 20s within months. Fortunes were lost. Retail traders got burned. And JPMorgan quietly accumulated hundreds of millions of ounces of physical silver while shorting the paper market into oblivion. Genius strategy. Buy the physical metal cheap while selling paper contracts to suppress the price. Profit from the collapse. Then sit on the inventory and wait. But that playbook required one critical condition: a market where supply could always catch up to demand. And that condition no longer exists. The silver mining industry has been underinvesting for over a decade. New mines take 7 to 10 years to develop. Existing mines are depleting faster than expected. And recycling? It barely makes a dent. Meanwhile, industrial consumption is accelerating at a pace nobody forecasted. Solar panel installations alone are projected to consume over 200 million ounces of silver per year by 2027. That's more than 20% of global supply going into a single sector. Add in EVs, electronics, and defense contracts, and you're looking at structural demand that cannot be reversed. And JPMorgan knew this. Their own commodities research division published reports acknowledging the tightening fundamentals. Yet their trading desk kept stacking shorts. Why? Because they believed they could manage the risk. They believed their market influence was enough to keep prices contained. They believed the physical squeeze would never materialize. They were wrong. Now let's talk about what happens next. Because this isn't just about one bank taking a loss. This is about the interconnected nature of modern financial markets and how a single miscalculation can cascade into systemic chaos. When JPMorgan starts covering their short positions, they have to buy silver futures contracts. Those contracts represent obligations to deliver physical metal. But here's the problem. The COMEX, the exchange where silver futures trade, has less than 100 million ounces of registered silver available for delivery. JPMorgan's short exposure, equivalent to over 500 million ounces. You see the issue. There's not enough metal to cover their position without triggering a price surge that forces every other short seller in the market to cover simultaneously. And when that feedback loop begins, it doesn't stop until the market clears at a new equilibrium price. And that price could be double, triple, or even higher than where we are now. History gives us clues about what this looks like. Go back to the Hunt brothers silver squeeze in 1980. Two Texas oil billionaires tried to corner the silver market. They succeeded temporarily, driving prices from $6 to $50 per ounce in less than a year. The Federal Reserve had to intervene. Margin requirements were changed overnight. The Hunts were bankrupted. But the lesson wasn't that cornering silver is impossible. The lesson was that when physical supply can't meet demand, price becomes meaningless. It simply goes wherever it needs to go to balance the equation. And right now, that equation is brutally out of balance. Then there's the palladium squeeze of 2019, a structural deficit caused by automotive demand and Russian supply constraints. Palladium went from under $500 to over $3,000 in less than 3 years. No manipulation, no conspiracy, just math. Supply couldn't meet demand. Price adjusted violently. And palladium is a far smaller market than silver. If silver follows a similar trajectory based on fundamentals alone, we're looking at prices north of $70 per ounce within 18 months. And that's without a short squeeze. Add the JPMorgan panic buying into the mix, and the upside becomes impossible to calculate. But let's zoom out even further, because this isn't happening in isolation. The global monetary system is fracturing. Central banks are stuck between inflation they can't control and recessions they can't prevent. Currencies are losing purchasing power. Trust in fiat money is eroding. And in that environment, hard assets become the ultimate refuge. Gold has already made new all-time highs. Bitcoin is consolidating after its run. But silver? Silver is still trading below half its inflation-adjusted peak from 1980. It's the most undervalued strategic asset on the planet. And when investors wake up to that reality, the rush won't be gradual. It will be a stampede. And the institutions know it. Central banks have been quietly increasing their gold reserves for years. Sovereign wealth funds are rotating into commodities. Even retail investors, the ones who got burned in 2011, are starting to pay attention again. Reddit forums are lighting up with silver discussions. YouTube channels are tracking inventory data. And the smart money? They're not talking. They're accumulating. Because they understand that when a market this tight gets hit with a liquidity shock, the early movers win, everyone else fights for scraps. Now here's where the leaked JPMorgan report becomes even more critical. Because it's not just about their exposure, it's about what it signals. If JPMorgan, with their market intelligence, their risk models, their access to central bank data, miscalculated this badly, what does that say about the rest of the financial system? How many other banks are holding similar positions? How many hedge funds are short silver derivatives they can't cover? How many pension funds have exposure through commodity indexes they don't even understand? The interconnectedness is staggering. And when one domino falls, the rest follow. Let's talk consequences. If silver doubles from here, which is entirely plausible given the fundamentals, the impact ripples across multiple asset classes. Mining stocks leveraged to silver production would see explosive gains. Companies like First Majestic, Pan American Silver, and others would become market darlings overnight. ETFs holding physical silver would see inflows that force them to buy more metal, amplifying the squeeze. But on the flip side, any financial institution, short silver, or holding derivatives tied to its price would face catastrophic losses. Margin calls would trigger forced liquidations. Credit lines would tighten. And in a worst-case scenario, you could see institutional failures that require bailouts. And then there's the currency angle. Because silver isn't just a commodity, it's money. It has been for 5,000 years. And when trust in paper money wavers, people return to what has always held value. The dollar index is showing cracks. The euro is struggling under energy crisis pressures. The yen is at multi-decade lows, and emerging market currencies are collapsing under debt burdens. In that context, silver becomes not just an investment, but insurance, a hedge against monetary chaos. And the demand from that motivation alone could dwarf industrial consumption. So what does JPMorgan do now? They have limited options. Option 1, cover their shorts immediately, take the loss, and move on. But that means buying aggressively into a rising market, which accelerates the very price explosion they're trying to avoid. Option 2, hold their positions and pray that some external shock crashes silver prices before they're forced to cover. But given the supply deficit and industrial demand trajectory, that shock would have to be catastrophic, a global depression-level event. And even then, industrial users would still need silver. Option 3, negotiate behind closed doors with regulators and other institutions to engineer a controlled unwind. change margin requirements, alter settlement terms. Basically, change the rules to avoid disaster. And if you think that's far-fetched, remember 2008. Remember how quickly regulations shifted when banks needed saving. It happens. It will happen again if necessary. But here's the thing. Even if they manage to contain the immediate crisis, the underlying fundamentals haven't changed. The deficit is real. The demand is real. And the supply response takes years to materialize, which means this isn't a one-time event. This is the beginning of a structural shift in the silver market that could last for the rest of the decade. And anyone paying attention right now has a front row seat to the greatest wealth transfer in commodity history. Think about what this means for everyday investors. If you're holding cash, you're watching purchasing power evaporate. If you're in bonds, you're getting destroyed by inflation. If you're in stocks, you're navigating the most overvalued market in modern history. But if you position yourself in hard assets, in real things that cannot be printed or manipulated into existence, you're building a fortress. And silver, at these prices, with these fundamentals, with a major bank caught in a death trap of their own making, represents the single best risk-reward opportunity available. Now, I'm not here to give financial advice. I'm here to present the data, to show you what's happening behind the curtain, to connect dots that mainstream media won't touch because they're too busy covering celebrity gossip and political theater. But the numbers don't lie. The leaked report is real. The supply deficit is documented. The industrial demand is measurable. And the short squeeze setup is textbook. Everything is aligning. The question isn't whether silver moves higher. The question is how violently, how soon, and who gets caught in the blast radius. And here's the final piece that makes this truly terrifying. JPMorgan isn't just any bank. They are the largest bank in the United States. They are a systemically important financial institution. If they sustain massive losses in the silver market, the contagion potential is enormous. Credit markets could seize, derivative chains could collapse, and the Federal Reserve would be forced to choose between letting a major bank fail or intervening to stabilize markets. Either choice has consequences. Either choice changes the game. So we're sitting here right now watching a slow-motion train wreck with a timeline measured in days, not months. The leaked report said 1 week. That was 3 days ago, which means we're halfway to the trigger point, and silver is already within $1 of the critical threshold. Every tick higher increases the pressure. Every hour that passes reduces JPMorgan's options. And every investor who understands what's happening is making their move. This isn't just a market correction. This is a reckoning. A reckoning for a decade of manipulation. A reckoning for a financial system built on leverage and lies. A reckoning for anyone who thought you could short a strategic commodity in the middle of a supply crisis and walk away unscathed. The bill is coming due, and it's going to be paid in full. So what do you do with this information? That's up to you. But understand this. Financial history is written in moments like these. Moments when fundamentals overwhelm manipulation, when reality breaks through the illusion, when the smart money separates from the crowd. In this moment, right here, right now, with a leaked JPMorgan report confirming what the data has been screaming for months, this is one of those moments. The next week will tell us everything. Will JPMorgan cover quietly and take the hit? Will they fight and trigger the squeeze? Will regulators step in and change the rules? We don't know yet, but we're watching. We're tracking every tick, every futures contract, every ounce of silver moving in and out of vaults. Because when this breaks, and it will break, the move will be historic. This isn't just about silver. It's about what happens when systems built on trust start to crack. When institutions that seemed invincible reveal they're just as vulnerable as everyone else. When markets that appeared stable turn out to be powder kegs waiting for a spark. And that spark, according to JPMorgan's own internal analysis, could ignite within days. So stay sharp, stay informed, and whatever you do, don't look away. Because what's coming next is not going to be announced on CNBC with polite commentary and gentle warnings. It's going to hit fast, hard, and without mercy. And the only people who benefit will be those who saw it coming and positioned accordingly. The clock is ticking, the fuse is lit, and the silver market is about to remind the world why it's called the devil's metal. Beautiful, volatile, and utterly unforgiving. This is the story they won't tell you. This is the data they tried to bury. And this is your warning. The next week changes everything. The question is, who's paying attention? If this analysis opened your eyes to something the mainstream won't cover, hit that subscribe button. Because this is just the beginning. The financial system is fracturing in real time, and we're going to document every crack, every collapse, and every opportunity that emerges from the chaos. This is your front row seat to the greatest wealth transfer in modern history. Don't miss what comes next.